It's November 25th, 2024, and this is the Watson Weekly, your essential e-commerce digest. Today on our show, how you should read the Gartner Quadrant. WordPress is the Craigslist of website builders. Target reports terrible earnings. Walmart reports great earnings. And finally, the Investor Minute, which contains 5 items this week from the world of venture capital, acquisitions, and IPOs. But first, in our shopping cart full of news, how you should read the Gartner Quadrant. Gartner has a tough job. Summarize an entire industry in a quadrant. The Magic Quadrant, which is the upper right of their diagram, is not a software selection tool on its own. By itself, it's a marketing tool to get vendors to pay it more. Stepping back from that, though, there is a lot of use in the quadrant. There are 2 axes on Gartner's quadrant, and one of which is more useful than the other. The first is the ability to execute. Does the company do what they will say? Can they deliver? In the age of efficiency, this may be all that matters. Completeness of vision is the second axis. But according to who? Is that for your needs? This is very fuzzy. Many companies, I think, can ignore this axis altogether. Another reason this is true? In a 20-year-plus category, it's quite possible the platform category is overbuilt, which means the most complete vision is also synonymous with bloatware. You don't want to be all the way to the right of this quadrant. The Apple iPhone is an example of a technology that would not be on the far right. Low-end disruption, anyone? From this lens, the Gartner Quadrant should almost not be a quadrant at all. Maybe it should be a line based on only the ability to execute. Who can execute the best? From that lens, here's how to read the quadrant. At the top, there are 3 primary companies in the mix. Shopify, which is great at execution and not bloatware. Salesforce is the incumbent, can execute, and there are a lot of great brands that do live here and they can deliver, but it might be heavier weight than you need. Commerce Tools can execute and cover a lot of use cases, but it may not be for everyone because they also focus on a lot of non-retail categories. The quadrant doesn't tell you how to pick between these 3 companies for your business on its own. Budget, ease of maintenance, no architect or dev team, how many customers are leaving one brand for another? Those things are not on the chart at all. From this lens, the lower right quadrant is death as far as I'm concerned, a very complete vision and low ability to execute. From this lens, Spryker and maybe even Adobe is kind of the cool story, bro, of the Gartner Quadrant. Says a lot, but may not actually do very much. There are 2 players with more potential than the others and have proven their ability to execute more than the rest, VTEX and BigCommerce. After that, you have a whole bunch of platforms, Shopware, Kibo, ElasticPath, etc., which fit a particular niche and don't have quite as many proof points as some of the others. As things stand today, this feels right. This is just one way to sort platforms. Other analysts have different sorting mechanisms. But Gartner is the biggest and the incumbent. Ultimately, completeness of vision as far as the quadrant is concerned seems to me that it's rewarded companies that tack on acquisitions, i.e. Hello, Adobe, and Salesforce, rather than platforms that work with a more ecosystem approach like Shopify or BigCommerce fall into this bucket to varying degrees. The Gartner line obviously does not sound as magical as the Magic Quadrant, so here we are. Still, the sorting doesn't look too far off from this point of view according to those criteria, which it shouldn't be your primary decision-making tool anyway, so what the hell are we even talking about here? Our second story. WordPress is the Craigslist of website builders. The fact that software exists out there as a virtually free way for anyone to build websites is both an issue and an opportunity. Note that when I say free, I don't mean exactly in a total cost of ownership way, but I mean it's well-supported and a reasonably priced way to do it. Not maybe forever, but it's definitely a way to get started. You don't need to look further than the fact that WordPress is 43% of all websites and 60 plus percent of the CMS market, according to the Google. This reminds me of Craigslist a little bit. Of course, Craigslist was disrupted by eBay, Airbnb, Amazon, Facebook Marketplace, LinkedIn, and hundreds of other small niches. Yet Craigslist itself has a large niche that is still going strong. And I think that's going to continue to be true for WordPress. The technology behind WordPress runs 162 times more websites than Shopify does. How many niches of websites is that? A fuck ton, and that is a scientific expression. And many are not enabled for e-commerce, or if they are, it's very basic and entire industries are only day one. There are 30 plus million e-commerce enabled websites worldwide, which is 6 times the Shopify number of 5 million, which is about the same number I've seen for WooCommerce implementations, which is the e-commerce plugin on top of WordPress by default. What does this mean for other providers in the space? Like in the last story, we talked about the Gartner Quadrant. The delta between the 30 million total e-commerce stores in the world and the 10 million provided by the big 2 providers is quite wide. And that is assuming most industries are digitized already, aka that this is a zero-sum world. Of course, the idea that we're living in 2024 in a zero-sum world is ludicrous. How many doctors or lawyers or dentist offices have you walked into that were using green screens? Quite a lot. But let's also speak about another popular topic here, the future of big commerce. I think it could be very bright, and there will be plenty of places for many winners across all e-commerce. It just may not be in all the same segment. Let's assume that big commerce powers less than 100,000 stores. The numbers I have seen are about 60,000. This means to triple its website growth, big commerce has plenty of available blue ocean to tackle. For any e-commerce professional, I would encourage you to look beyond the zero-sum game of direct-to-consumer fashion retail, which seems to be what everyone only talks about, because it seems like it's the hot thing. It's also the bloodiest red ocean that exists. Want to find the next $100 million niche? I would encourage you to look to WordPress for inspiration. All the answers are probably already there. Our third story, Target reports terrible earnings. You knew the Target earnings were terrible in the first 5 minutes of the call. First, there's like 6 senior executives on the call, which well-run companies I find don't allocate this much effort to earnings calls. Second, they mentioned growth in traffic as one of the first metrics out of the CEO's mouth. Just to recap and decode earnings language, if you can't talk about profit, you talk about revenue. If you can't talk about revenue, you talk about nonsense metrics like traffic. Here are a few key points from earnings outside of this. Consumers are spending cautiously in discretionary categories. Brian Cornell forgot to add the phrase "at Target" to this statement. If you don't have a promotion or an everyday low price, the consumer is not cautious, they are simply not motivated. Like the movie Office Space, what we have here is a problem of motivation. Second, a few key stats I did take out. Target had a 20% growth in drive-up and same-day delivery, 11% growth in their digital channel, and a 15% growth in the ad business. But that is kind of a terrible growth rate for a small ad business, relatively speaking. My third point here is that Target is bearish on consumer sentiment. Consumer is cautious in home and hard lines, although Walmart didn't report this. Consumers are telling Target that their budgets are stretched, which is true, yet the company is trying to replicate the Walmart everyday low price approach, but for fewer items and not as quickly. In short, Target is losing share. A day after Walmart reported smashing earnings, this is a tale of 2 companies. Fourth, Target experienced supply chain issues. The company was affected by East Coast and Gulf port strikes. Again, I ask, why? The only supply chain issues mentioned on Walmart's call was how much more efficient they're getting. Like Avon Barksdale said in The Wire, Target always seems a little slow or a little late. In this case, both. We are just seeing uneven performance. Target is essentially a tremendous house of brands at this point, and a good one at that. But as a retailer, they got 99 problems if we're sitting here talking about traffic. In my mind, If you can't get consumers to walk into your Target store, you need to push those $10 billion plus brands into any channel you might find a consumer. Sound crazy? What the hell is the alternative? But here we are. Traffic without revenue means Target's reason to exist is declining, not growing, and their consumer value proposition is declining. Finally, I end with Target management team, reinvent yourself. Fresh blood is definitely needed. Target is looking for a CMO, but it could probably stand a new CEO as well. Mr. Cornell has had enough time to steer and adjust Target. Whatever the plan, and I'm not saying I have all the answers, bolder action is warranted. And our last story. Walmart earnings show strong growth in high-income consumers. Everyone wants to save money, and everyone wants to save time. Walmart is currently delivering growth, 75% of which is coming from high-income consumers making over $100,000 a year. And this is not a new trend for Walmart. Why the growth in higher-income consumers? First, broader assortment by marketplace, pickup and delivery convenience, saving money. And second, in the battle between price and convenience, Walmart chooses both. A few stats are in order. U.S. e-commerce sales growth is 22% and globally 27%, whereas Amazon is more like 7%. U.S. Walmart Connect, or their ad business, is up 26%, and globally that is up 28%, whereas Amazon is 19%, obviously on a much higher base. Overall sales for the entire company grew 6%, and their profit is up 10%, right on their formula. Membership income at the company is up 22%, which is an encouraging sign. And 18% of Walmart is now e-commerce, which is 300 basis point improvement from last year. Why the growth in operating income in Walmart? Membership fees and advertising income drove more than half of the operating income improvement and about 1/3 of all Walmart operating income together. On the marketplace front, Walmart Marketplace grew 42%, and they've had greater than 30% growth in the last 5 quarters. Walmart's total SKU count is approaching 700 million items. And the company's sales in beauty, toys, hardlines, and home on the marketplace grew greater than 20%. From a supply chain point of view, store-fulfilled delivery is up 50%, improving density as well. 50% of fulfillment center volume is now automated, and there's a 40% reduction in cost per order. In terms of a synopsis, there's that phrase again, operating income growing faster than sales. Amazon, for its part, is being attacked at the top by Walmart and at the bottom by Temu, but both attacks are somewhat coming at the high-income consumer because everyone wants to save money. Temu is coming for the time-insensitive items, and Walmart is coming for the time-sensitive items. The consumer is resilient, but still, there is a low single-digit deflation in general merchandise on higher unit volumes. This kind of environment plays to Walmart's strengths and is forcing Amazon to adapt and improve its playbook. Walmart says that the economy has neither accelerated nor decelerated. It is steady. And while Amazon is focused on parrying Temu, Walmart could drink its milkshake. The numbers above certainly give it more room to run. But the biggest reason for Amazon to fear Walmart? The growth of Walmart Plus. The playbook is working, the selection is growing, and the pickup and delivery options are unparalleled. The two titans really are duking it out. It's that time, friends, for our Investor Minute. We have 5 items on the menu today. First, Advance Auto Parts to close 523 corporate stores and exit 200 independent locations. Advance Auto Parts, an automated parts retailer, is set to close over 700 locations and 4 distribution centers as part of restructuring by mid-2025. The company estimates total costs of $350 million to $750 million from the closures. Earlier this month, Advance Auto Parts completed the sale of automotive parts wholesaler Worldpac to global investment firm Carlyle for $1.5 billion. Advance Auto Parts believes it's on a journey to improve its adjusted operating income margin by more than 500 basis points through fiscal 2027. Second, Orderful, a B2B integration platform for electronic data interchange, or EDI, has raised $15 million in growth funding that will be used to accelerate product development and expand its global reach. EDI is a painful problem for brands, 3PLs, and retailers, and requires an API-based solution to make data transmission between platforms less painful. Third, buy now, pay later giant Klarna files for IPO in the United States. Klarna, a European-based fintech platform that offers consumers short-term financing online and at retail checkout, has confidentially filed for an initial public offering with the Securities and Exchange Commission. The number of shares to be offered and the price range for the proposed offering haven't yet been determined. The Swedish financial services provider, valued at $6.7 billion in 2022, wants to raise capital in its largest market, which it wants to expand further. Fourth, Brightpick raises $12 million to accelerate rollout in the United States. Slovakian warehouse automation startup Brightpick, a spin-off from Photonio, 3D robotic vision sensors and intelligence platform, has raised $12 million via equity and debt. The new funding will be used to deploy Brightpick robots in the United States. Startups in the robotics center continue to raise funding as warehouse and 3PL companies lower employment costs and provide efficiency and scale. And finally, Luzerne e-commerce announces acquisition of Tambo. European marketplace agency Luzerne e-commerce has acquired Tambo, a UK-based Amazon agency, for an undisclosed amount. The acquisition will enable Luzerne to offer brands an end-to-end solution by combining Tambo's 1P solutions with Luzerne's 3P capabilities. Over the past 12 months, we've seen agencies acquiring Amazon-specific agencies to offer brands deeper marketplace and marketing services. And today's final word of the week for Thanksgiving week is Cyber Week. Okay, maybe that's 2 words, but our Super Bowl is here, folks. What the hell are you listening to this podcast for? Get out on the field and delight those customers. Did you know that RMW Commerce is a brand new podcast? Check out the Watson Weekend for an unfiltered and lively chat each week with me, Rick Watson, my co-host Jess Liseski, and an array of interesting guests and topics, all focused on e-commerce. You can find the Watson Weekend by searching for it on iTunes, Spotify, or YouTube. That's all for this week. Till next time, Watsonians. Hi, I'm Rick Watson, CEO and founder of RMW Commerce and host of the Watson Weekly Podcast, your essential e-commerce digest. Our production partner for the series is Citizen Racecar. The show is produced by Jose Baez. To hear new episodes of the show every Monday morning, subscribe now at rmwcommerce.com/WatsonWeekly and wherever you get your podcasts.